Hey everybody, thanks for being here. This is a Let's Talk Money channel live stream every Sunday. So we're doing these every Sunday at 1 p.m. Eastern, 10 a.m. Pacific. If you can make it, love to have you here. Love talking this opportunity to talk back and forth with the community and really answer your questions and talk about some of those money goals we have. We just passed a huge milestone. While I was getting ready for the live stream here, we passed 66,000 people in the community. So that's 66,000 people that are, wanting to beat their debt, make more money, and make their money start working for them. So that's a great feeling to have so many of you on board and interacting, engaging with the videos as they come out Mondays, Wednesdays, and Fridays at 10 a.m. Eastern. We're going to have a great live stream, very important live stream today. We're going to do some community shout outs first, highlight a few of the videos from last week and then next week coming up. But we're going to get right to this week's live stream conversation. This week's topic is going to be, finding that balance in your money goals. We talk a lot about, which is about paying off that debt, making money or investing on the channel. But we really don't talk a lot about prioritizing that. Which should you tackle first? Which should you tackle last? How to find your balance within that. And hugely important, something that people don't spend enough time with. And I think there's a lot of myths and misconceptions around there, especially with that paying off debt and some of those other two. So it's going to be a really exciting live stream. See a few people, coming in. Drew, how are you? Is that Lola or looks like Lola? Hello. Good to see you here. Again, thank you for being here every Sunday, 1 p.m. Eastern, 10 a.m. Pacific, to answer your questions and just kind of hang out. I mean, that's one of the things that I've loved about building this channel is just reaching out to everyone in the community, having this back and forth and this face-to-face relationship that I never got on the blogs, and really talking about creating that financial future that we all need to get to. And then, after we're done with that topic, we're going to start talking do some Q&A, answer all your questions. Philip, Matthew, Ura, Vet. Okay, so let's get to a couple of your comments. Some comments that I saw this week that I really wanted to highlight because some great points, great ideas. I always just love to give a little bit back to the community, the people that comment on the videos, taking the time to engage and really be a part of the community. So let's come over here to. So this first one's from Lance, and this one was after a couple of stock picking videos about beating the market, that kind of thing. I think actually this one was on last week's live stream. Lance was saying, I feel that doing all this research may or may not get you more than maybe 0.5% gain over long periods of time each year on the market. He's saying you might as well passive index fund. So basically just put your money in a group of index investments to get stocks, bonds, and real estate broadly, not worrying really about beating the market, but investing broadly across those asset classes. And I actually agree completely. I love talking about investing, love talking about stocks and picking stocks because that's where I'm from. 10 years as an equity analyst working for venture capital firms and private wealth management. And there's something that a lot of people don't understand about stock analysis and picking stocks and that side of the industry is that, when you're an analyst, then it makes sense because you're selling your profession. You're in your career and you make money off of analyzing and picking stocks. Same goes for the portfolio managers and venture cap and all that. But for the vast majority of people, there is a trade-off that you have to understand about picking stocks, spending that time to actually research and understand individual stock picks. And it might not be worth it. There is a trade-off. Like I said, if you look at, so if you've got $10,000 worth of stocks, and we'll just use an example, if you can beat the market by 10%, which is it's a huge goal, lofty goal. It's probably not going to happen, but we're just going to use that as an example. That's actually what we're doing on the 2019 dividend portfolio that we're running, and I'll update you on that in a little bit. We're actually beating the market by 10% so far over the first 4.5 months. So let's just say hypothetically you can beat the market by 10% every year by spending maybe 3 hours a week analyzing, picking stocks on that 10,000 portfolio. That is actually so it's about $10,000 a year you're getting by spending that time. It's actually only $83 a month on that extra 13 hours. So even some larger portfolios, even if you've got a portfolio of $100,000 and you get that 10,000, so that's $10,000 extra each year by picking stocks if you can beat the market. That's not a whole lot. So a lot of what we're gonna talk about today is finding that balance in investing and making money, and kind of prioritizing that stuff, because so even that $10,000 a year extra, around about $800 a month, $830 a month on 13 to 15 hours. That's not very much on a per hour basis. So I can actually show you a lot of the money making ideas that we cover on the on the channel. So blogging, affiliate marketing, YouTube, what I'm doing here. It's really easy to make 25, 50 bucks an hour and even more. So I passed averaging $10,000 a month on my online assets. Spend a little bit more, 50, 60 hours a week, just because I enjoy it. But quite a bit more than that money that you're going to make by spending the time analyzing and picking stocks. So not saying that you can't pick stocks, you can't have a good time and do some of that individual stock investing, but understand there is a trade-off, and getting the most out of your time, really. So great comment there by Lance. Our next comment is here by Raphael. And he says, could you do something on socially responsible investing? I think it's important for this day and age. For me, not all money is created equal. And I can't believe I haven't done a video on socially responsible investing yet. It's a great topic, interesting topic that has really become more popular over the last decade or so. And basically, socially responsible investing is just investing with an eye towards companies that are looking after the social good, so you're still trying to get those returns, still trying to make money, but you're also investing for the social good. And a lot of so the basic responsibility of a company is or of a board of directors, the executives, is to create wealth for shareholders, for the stock owners of the company, right? And that was the traditional view. And then over the last 10 years or 15 years or so, then they started kind of building in that social component. So with socially responsible investing, a lot of times you're looking at not investing in companies that might be vice stocks. A lot of times they'll call it, might be harmful to your health. So you're talking tobacco, gambling, stuff like that. And I don't like to make judgment calls a lot on the channel. I like to just give you the facts and let you make your decisions. But yeah, a lot of these stocks that are maybe harmful to the environment, a lot of these traditional fossil fuel companies, things like that socially responsible investors don't want to be supporting, basically. So that was another good comment by Raphael, and I'll probably be doing a socially responsible investing, a little bit deeper look into that pretty soon. Last comment here was by Greg. Thank you for the stock ideas. This one was after Friday's video, which just hit 20,000 people viewed it in the first 2 days. Fastest video by far of any hugely popular video. I'll talk a little bit more about that in a minute when we review those. But he pointed out that all the individual stock picks started with C, and thought that we might be doing an alphabet ticker series, which was kind of funny. He's in on dividend growth investing, and it's a question I threw out during the video, whether you wanted to see more on dividends or whether you wanted to see more on on growth investing. So be thinking about that and what kind of videos you want to be seeing. And he also wanted to see more on different valuation techniques like the DCF, which is discounted cash flows, dividend yield theory, things like that. So great comment. I'll be doing more on specific valuation techniques in the near future, talking about how the analysts actually pick stocks and stuff. So that was some great comments there. I appreciate everybody's comments, all the engagement that I get on the videos, just talking back and forth with you here on the channel. That's kind of why I do it. Just have that face-to-face relationship. So now we're going to go over talk about some of the stuff that we talked about last week and what we're going to talk about this week, and then we'll get to that prioritizing your money goals and really getting the most out of those priorities. Because yeah, you can focus on beating debt or making money all at once, but you're not getting quite as much out of your money as you could to finding that balance. A lot of people still here. So John, thank you for being here. Bob, Philip, Greg just talked about your comment there. Lydia, great investing channel there. My investment journey. Welcome. So yeah, like I said, we just got done with a couple of weeks of stock picking and investing videos. Always love talking about that side of the finances. Like I said, one of the videos that we did was our May portfolio update for our 2019 stock market challenge, and I will share that there. So this is the portfolio that we've got as of today. Doing almost 25%, which I think the S&P 500, the stock market is right around 15% for the year. So like I said, we're beating the market by about 10%, which is great. Always love seeing that. This little dip here is when I rebalanced a few things just this last week, and I wanted to talk about that because we don't have another portfolio update for almost a month now. For the next month, that'll be out in May, but I wanted to talk to you about kind of what I'm looking at as far as updating the portfolio. So for those of you new, it's a dividend stock portfolio. I started off with 10 stocks in January. $1,000 on M1 Finance here. It's a great M1 Finance is a great no-cost investing platform that actually has IRA and Roth options. So those retirement account options which aren't available on Robinhood. So that's why I picked M1 here. You can always deposit money, rebalance, do whatever you want to do, and it's always no cost. So a great way to save money on investing. But so we started with 10 stocks in January. I ended up adding another one in February. I added ConAgra Foods, which is already up 34% over the last 2 months. And then just this last week, I added 2 more stocks. I rebalanced a lot of the individual stocks. So I took some profits in some of our stocks like Hanes Brands, which is up 63% so far in the last 4.5 months. We see 1, 2, 3, 4, 5. 5 of the stocks are up over 30% so far this year. And what is this? 5, 6, 7, 8. 8 of them are beating the market. We've got a few laggards here. We've got PPL, which is a utility company, which you wouldn't expect to beat the market when the market is growing anyway. But it's a little bit more safety and stable when stock prices do come down. So that's why I've got that one in there. This iShares Europe fund, which is a fund of financial stocks from Europe. So Europe's been kind of lagging a lot, but I think this could be the year that financials rebound a little bit in Europe, and some of those things that we've talked about in our previous monthly updates have clear out. And then the Alarian MLP we've talked about. I think we talked about that in our last month's update as well. That's a fund of transportation or pipeline companies and energy storage companies. So some great dividends there. I think the average dividend yield on that fund is like 6%. So it's a huge dividend yield. Now, what I did this week, I did, like I said, I sold out of some of the profits in this because, and something we'll talk about in our next month's update is that the stock market just looks kind of weak for the rest of the year. We've already had 15% S&P gains over the first 3 months, which is pretty unheard of for a lot of years. A lot of the economic forces coming down don't look great for the stock market, so I took some profits, put them in these 2 funds, the XLU, which is the Spider Utility Fund. It's a fund of utility companies, great dividend yield, plus it's going to be a little less volatile than the market if the stock market does come down. I also put some money in our BLV, the Vanguard Long-Term Bond Fund, which I looked at the portfolio and realized we have no bonds in that portfolio. And everyone in the community knows I'm a huge believer in that asset diversification. So we've got stocks, obviously. We've got our real estate exposure in the fund. So we've got those 2 assets, but we didn't have any bonds. which, I understand even if you're trying to beat the market or, really trying to reach for those returns, it's still important to have something in bonds just for that safety. And plus, if stocks do pull back, that gives you the opportunity to take some of the bond fund out and, and take advantage of those lower prices in stocks. So added to the XLU and the BLV there. But like I said, still doing about 25% on the year, which is an excellent return, and I'll take that any day of the year. In fact, I think we looked at a chart in our last update, and only 6 or 8 out of the last 32 years have had returns over over 25% on the stock market. So basically, we're beating the stock market's performance, annualized over the last 30 years or so. The other video we did, like I said, Friday's video has boomed. 20,000 plus people have already watched it. I've actually linked that in the first comment in the description box below, and it's probably one of my favorite topics to talk about is this long-term macro investing. For our 2019 stock market challenge, I picked a lot of stocks that, maybe I'm not all in for the long term for 20 or 30 years, but I figured they'd do really well this year. So we've got stuff like Hanes Brands. Didn't really look at it quite so much for the long term, for that 2 or 3 decades, but I loved some of the the upside, near term upside to the stock, and as you see, it's up 63% so far this year. But what I looked at in Friday's video is basically how to find those long-term themes, those macro themes, those themes that are going to push stocks for the next 20 or 30 years, and invest according to that. And why I love that idea is because, like we talked about, you can spend 3-5 hours a week picking stocks, watching stocks grow, and get maybe 5-10% annual return. But it takes that time. It takes that 5 hours a week, 20 hours a month. That's a part-time job for a lot of people. So what you can do, though, is if you want a little bit less stress in your investing, but you still want to pick some stocks, is you can look at those long-term themes. Okay, so we talked about things like the aging population, demographics, those 10,000 baby boomers that are retiring every single day. You've got things like AI, so artificial intelligence, the rise of robotics. You've got things like other things we've talked about, like self-driving cars, stuff like that. You look at these large forces, these grand forces that are pushing on all stocks, and you take those themes, those unstoppable themes, and you say, okay, which industries, which products categories are going to be most affected by these. So you don't necessarily have to pick one stock. For example, okay, and this is something I actually didn't even talk about in the video, but it's something I've been looking at very closely. The self-driving revolution, right? Hasn't really taken off quite yet, but over the next 2, 3, 4 years, we're going to see a boom in that self-driving technology. Well, what does that mean for taxi companies or ride-sharing companies like Uber and Lyft that just went public? What does it mean for trucking companies? Trucking companies pay out it's upwards of 30 to 35% of their total costs. All the costs that go into trucking companies are that driver hourly wage or that driver wage. So what happens when you have these self-driving trucks and they don't have those huge wages? Or those, I won't say huge wages. My dad was a truck driver for 20 years, and it's definitely not huge wages. But what happens when that 30% that trucking companies had spent to those wages are no longer necessary? So you look at these broad forces and these companies or these industries that are going to be affected, and you can see where there's going to be some very, very big winners in industries. So yeah, I linked to that post or that video in the description below this video. You'll be able to click through that, or just go to the videos page on our on the channel and look for that. Great video. Again, like I said, 20,000 plus people in the last 2 days have watched it. It's booming. That's by far the fastest growth of any video on the channel. So by far the most popular yet. Next week we're gonna shift gears a little bit and talk about 2 of the videos we've got are our best teen jobs and best college jobs. Really I think I do 5 jobs for each one, so 10 jobs, perfect for teens and college students. And really, a lot of these are going to be for anyone. There's going to be some great ideas that you can do from home. You have flexible schedules, things that would typically work for a teenager or a college student where they have that class schedule. But anyone that wants a flexible job to make money from home kind of thing. What's going to be important here, though, is how it's going to set up those teenagers and those college students for for their future. And that's one thing that I talk about in both of those videos is you don't get the traditional job. You don't need me to tell you that you can get a burger flipping job while you're in college or while you're a teenager. But it's a horrible job because it puts you in that per hour trap. It makes you a slave to that per hour wage, and basically you're just doing nothing for 4, 5, 8 hours a day. And you're learning nothing, you're making next to nothing. So I've got 10 jobs for teens and college students that will actually make them money, make a job that they'll actually want, but it'll also jumpstart their future. So be on the lookout for those. Monday and Wednesday, got those coming out. And then Friday, I've got a blog about making money blogging. Like I said, I started my blogs in 2013. I loved it, building those online assets, building that digital business, and just past 10,000 a month averaging just this year. So some great ideas there. Now we're going to get to our live stream topic. I see a lot of people still joining. Crystal, guys. It's a couple people that I recognize from the comments on the videos. Thank you. I always appreciate that engagement in the comments. Chucky, Jeff, with your blue dress uniform. Yeah, no. They're pretty strict on the uniform there. No bow ties with the uniform. But I missed wearing the uniform actually. When I was in college, make some extra money on the weekends. Yeah, but delivering pizzas. Made extra money, a little bit, but what can you say you really learned about it? I mean, other than, maybe fast, friendly service to get a better tip. But yeah, some of these jobs for teens in college are really going to look at, building a business and, something that's going to shock people when they see it on your resume. It's really going to help the future. So now, like I said, what I want to talk about for this week's live stream is really prioritizing those financial goals and which is better. We talk about beating debt and making money and investing on the channel. And I think there's a lot of misconceptions going out in the personal finance community that are really hurting people rather than helping them. Some questions like, should you pay off debt before investing? And that one's really kind of hurts. I get sick just a little bit every time I hear that one, because I know a lot of people are paying off their debt, are waiting to invest. And let me tell you, shopping is just too much fun, right? And spending money is too much fun. A lot of people, they may never be completely out of debt, so you're getting caught in that hamster wheel of, trying to pay off your debt every month, trying to pay off those credit cards, trying to pay off those personal loans and other debt. And you never quite get there. And so you never quite get to investing. And so like I said, not everyone is going to be completely debt-free at one point of their lives. But God willing, what everyone will be sometime in their lives is retired or basically, living off of their investments. So you have got to start investing, whether it's, while you still have debt or what. And what I like to say is even if you only put $50, so prioritize that debt payoff, especially those higher interest rates. Anything over 15, 16% maybe. Prioritize debt payoff, but put $50 a month into an investing account, and you will be amazed. $50 a month, and I've done the math on the channel before, but $50 a month at maybe a 7-8% annual return actually becomes a little over $100,000 over 30 years, which is not enough still, but $50 a month, that's one time eating out. So it's definitely a great start. But what it does is it gets you in that habit of saving, gets you in that habit of investing, taking advantage of that compound interest. So it's so important to get started. Like I said, if you got debt 15, 16% or more, go ahead and prioritize that. Put your extra money towards that, but save out that $50 a month to invest. always max out your 401k, your IRAs, that kind of thing, because that's free money. If you're getting an 8% return on your investments, but you're getting that 50% match from your company, that's free money. That's like an instant return. That's like an instant 50% return on your money. Better return than you'll ever make on anything else. But then, we've got other questions here, like, is making money better than investing? And we talked a little bit about that, earlier. Is it better to spend, that 5 hours a week picking stocks, understanding stocks, and that kind of thing? Or is it better just to spend that time making money, building your online assets, and then that extra money just index investing? So investing in a few Vanguard funds, not worrying about trying to pick stocks or beat the market. And generally, I would say for most people that yeah, I mean, you're going to make a lot more money on some of these online assets, these businesses that we talk about on the channel, than you ever will with investing. Like we had that example. If you've got a $10,000 portfolio of stocks and you can manage to beat it by 10% a year, you're still only making $1,000 a year, right? And let's say it took you that 3 hours a week. So 13 hours a month for $83 basically in extra return. And like I said, a lot of these online businesses, you'll make $25, $50 an hour easily, and even more. But you still you've got to balance all of this, right? You can't just focus on one. And I think that's the real message here. Budgeting is hugely popular here on YouTube, and I love some of the budgeting videos I see and things like that. But you're always going to be limited to your income. You've got a $3,000 a month income. You can only budget so much, right? You've got to pay those basic living expenses. And I mean, if you could budget down to saving 75% of your 65% of your income, you're saving $2,000 for investing or for whatever you want to do, but you're always going to be limited to that. You can only cut it so much. Investing as well. You can spend all the time learning about investing. You become a CFA charter holder and a professional analyst and all that, but you're always going to be limited to your portfolio size. You might be able to make 10% extra returns on the market, but if your portfolio is only $10,000, that's only $1,000 a year gain, right? Even at $100,000, that extra 10% is only $10,000 a year extra. So you're always limited to that portfolio size, whatever returns you're going to get. So what I wanted to help you with this channel and why I created this channel is to talk about some of those ideas for making money, those online businesses, those passive income ideas, to really kind of free you from those limits. So you're making money. With that money, you can invest it. You can take some to pay off debt, and kind of help you balance that. One other question I get a lot of times on this was, should you invest in a business to make more money, or should you pay off your debt first? And this is kind of similar to the pay off debt versus investing question that we talked about, and you really got to balance it. I mean, right off the top of my head, then I would say invest in your business, make that extra money, because you can make so much more. Like I said, I make $10,000 plus a month on my online businesses, and I never could have done that if I hadn't invested that time and a little bit of money in starting those. But like I said, you want to find that balance. You don't want to let your debt get out of control while you're trying to build your businesses. So it's all about a trade-off. So I want to go to your questions here. If I didn't get to your question, if you asked it earlier in the live stream and I didn't get to it, go ahead and answer it again, and we'll answer some questions here. What do we have? What type of account would you recommend to park an emergency fund? Okay, it's a great question. Emergency fund is basically, that cash stockpile of your money that is for emergencies, right? And there's an important point there that a lot of people don't realize. A lot of people, they say, okay, so I've got these $5,000 in emergency cash, emergency fund, but I want to make money off of it. Right, so really safe stocks, right? I'll put it in Disney, or I'll put it in Apple, which nobody's saying that Disney or Apple is going to go out of business, so they think that's fairly safe. Well, the problem is you never know when an emergency is going to strike, right? An emergency is, a big car payment, a big, healthcare deductible, stuff you have to pay that you wouldn't know otherwise. Losing your job. And it used to be that you would need they said you need 3 to 6 months of your monthly expenses. So not your income, but your actual expenses times 3 to 6 months for your emergency fund. And what we saw is that, generally was an okay idea until the last recession. And then the average time people were out of work was like 26 months. So completely devastating for a lot of people. So I would say, maybe err on the upside of that. Start off with 3 to 5 months of your expenses, and maybe even go a little bit higher, 6 or 7 months. And what you can do is, at minimum, you need enough to cover like your health insurance deductible or your car insurance deductible. You need at minimum a few of these. So even if you don't lose your job, but you've got that high deductible health plan, right? That qualifies you for that health savings account, right? Great tax-free investing account or tax-free savings account. But that's generally around $3,000. So you need at least $3,000 to cover that. Whatever your deductible is on your car, you need something for that. But I would say start with 3 to 5 months for your emergency spending. Now, as far as what type of account you want to have this in, it sucks. It sucks not to be making money off of it, but you've got to have it in like a basic savings account. And a lot of these online accounts, I did a review of the Capital One account a few months ago, and they're actually paying around 2% a year, annualized 2% interest on their savings accounts, which is an excellent savings rate compared to some of these traditional banks. You have it in there. You can have it in CDs, money market funds, some stuff like that. But remember, this is emergency money. You never know when you're going to need it. So if you've got it in something even as safe as a treasury bond, then you don't know. If you're taking money out of some of those treasury bonds and some of those bonds, they have early walkout features where you lose some of your money if you or you don't get the interest if you take the money out early. So you really want to be cautious about that. At most, you might have it in some of these longer term or shorter term bond funds, right? So a very short term bond ETF. Now, since it's short term, then interest rate changes aren't going to affect it too much. And since it's a bond fund, the stock market up and down isn't going to change it too much. So if you look at some of these funds, then you'll see that they vary or they fluctuate very, very rarely. So that would be at the very riskiest, I'd say, for that. So what other questions do we have here? Thanks for all your videos. Just some shout outs for people. Greg, nice songs. Thanks for being here. Terrence. What else? About using ex-dividend date strategy. Haven't really looked much at that, and I assume you're talking about looking at stocks that are going to go ex-dividend soon, investing just before that ex-dividend date, which is that date that everybody that holds the stocks before that date gets the dividend. And then basically you can sell out. Now the thing with that is for tax purposes, you have to hold the stock for 60 day. I think it's a 60-day window on either side of the dividend date. So a little bit harder to manage that strategy for that. If you do sell it within that window period, then you pay higher taxes. You actually pay income taxes on that dividend amount, which really eats into your returns. In fact, I've seen some research that it completely eats all those returns out that you would normally get on that ex-dividend date strategy. What you can do is if you've got a retirement account that you've got dividend stocks in, then you might use that since you're not paying taxes on the dividends and the returns until you withdraw the money in retirement. So that might be an idea if you do want to use that ex-dividend date strategy. What else we've got? How is your online business going? Pretty damn good, actually. I run a a spreadsheet tracking all my expenses, all my revenues, and it just goes up every year. And it's one of the reasons why I love talking about it so much here on the channel is because it's really that financial freedom that you talk about. I enjoy growing the businesses. I enjoy having that control, and there's some online assets that anyone can do, and they just keep growing. I just started the YouTube channel in December 2017. 66,000 people are part of the community, make about $3,500 a month on just on the ads, another $1,500 or $2,000 a month on sponsorships and affiliates and stuff like that. The blogs, still growing, 5,000 or 6,000 a month from those. Affiliate marketing, if you're not if you don't have a side hustle, if you don't have one of these online businesses or online income streams, you need to get started. And it's not just for the money. Something we talked about last week. It's it's what I call income income insurance, right? Because none of us knows what AI, what robotics, and that kind of thing is going to bring to the future. 30 years ago, you'd get a factory job and be fairly confident that you had a job for the next 30 years and a great pension. And now what's happening to a lot of these people? A personal example. Like I said, my dad drove a truck for 20 years, but there's a very, very high likelihood that in the next 3 to 5 years, self-driving automation is going to be replacing a lot of truck drivers and a lot of taxi drivers and a lot of those rideshare drivers. So, what do you do? What do you do if you've been driving a truck for 20 or 30 years and you really don't have any other source of income or any other of these skills that's going to make you competitive in the workforce? So you really need to be spending a little extra time. It's not going to be easy because it's going to be 5 hours a week of learning how to create these online assets, these online businesses, and picking one that you enjoy and going with that, because you have to have that insurance, and the money's not bad either. It's really that financial freedom that we talk about. What else do we have here, Greg? What other questions do you have? BSVS, what do you think? Fixed annuities. Okay, Mark's asking about fixed annuities, and basically an annuity is just it's an income stream that you buy. It's sold by mostly by insurance companies, and they're saying, okay, if you give us $100,000 now, we will give you $2,000 a month after a certain point of your age. After maybe 65 or 70, we'll give you $65 a month until you die. Basically, it's guaranteed income. They've got a couple of different kinds of ways you can do it as far as how you receive the money. And I actually talk about this in the investing course. It's one of the retirement investing strategies that I talk about, is kind of combining that with the bucket approach for retirement investing, or the ladder approach, matching your expenses. It's the problem with annuities is you kind of need a big portfolio, because the rate of return on these annuities is usually right around 3 or less than 3%. Right, and that's the price you pay for that guarantee, right? These insurance companies, they're going to reinvest that money in super safe bonds, other stuff, so they're not going to be earning much of a return either. But it's the price you pay for that guarantee. So if you've got a larger portfolio and you want to try to guarantee some of that income in retirement, then it's an option. But for the vast majority of people, it's really not something that they can take advantage of, because that the return on their money and that the return or the cash flow that they're going to get on maybe say $25,000 or $50,000 invested just isn't enough. It's not enough to really provide them cash in retirement. What's a good online side hustle to start with, Spencer? I've learned a lot about, not sure where to start. I'd say start with a blog. It's where I started with. And there's a lot of other online hustles that you can do. But the reason why I say start with a blog, and we've got a 5-video series on everything you need from getting your blog online, picking a name, picking a topic, everything to the income sources that I actually use. So look in the on the Let's Talk Money channel. There's playlists, and then I think it's called how to work from home, how to start a blog, something like that. I can put that in one of the comments below. But a great video, and I've actually got a free checklist that you can download with that. The reason why I say start it with a blog is because a blog is going to be kind of your stepping point to a lot of these other income sources. With a blog, you can do sponsorships, you can do affiliate marketing, you can you leverage the power of your blog with your YouTube channel. One of the reasons why I think that our YouTube channel here on Let's Talk Money has grown so fast is because I'm getting people from the blog back and forth. I'm leveraging that that off YouTube space to bring people to YouTube. Always amazes me as some of these YouTube stars that don't have a blog, that aren't using that leverage back and forth. And I think it's really hurting their growth. So I say start with a blog. Now, if you want more of an e-commerce online idea, then Amazon FBA, and this is something we've talked about on the channel, is an amazing opportunity. Basically, you start your own retail company, and you can do this with as little as $3,000 to $5,000. Basically, you're looking for stuff that's manufactured in China. You find a manufacturer through Alibaba. So it's a website, a Chinese website that helps you connect with manufacturers. You test the products and all that kind of thing. What they're going to do, they're going to slap your label, your logo on the packages, and they're going to ship the packages directly from the manufacturer to Amazon's warehouse in the United States. You've got an Amazon page for all your products, and you do different marketing ideas and stuff like that to sell from Amazon. And then, of course, Amazon ships directly from its warehouses to your customers. So why I say this is a really cool opportunity is because, traditionally, think even 10 years ago, 10, 15, 20 years ago, you would need, hundreds of thousands or millions to start your own retail company, right? You need the factory space, manufacturing, you need all the logistics, everything set up. Well, now, for as little as $3,000 or $5,000, you compete with Levi's, you compete with Tommy Hilfiger or any kind of retail store with just basically with FBA. So it's a really neat opportunity. It costs a little bit more to get started, but yeah, I would say start with a blog, because that's really where a lot of this other stuff you're going to be able to leverage that blog. That distribution and that traffic to really grow some of these other online assets. What else we got? Other questions? There's very bad job market in the near future. Would you invest? Mark asks, would you invest $25,000 in REITs? Well, first you gotta wonder, okay, how much is your total portfolio? Now, if you've got a $25,000 portfolio, no, of course I wouldn't invest $25,000 in REITs, because you'd have all your money in real estate. And I'm a huge real estate fan. I am all about real estate. Got my first job as a commercial real estate analyst in college, and I've managed my own portfolio and analyzed some of these REITs professionally. But you never want everything in one asset class, whether it's stocks, bonds, or real estate. I would say for the most part, for most people, probably about 20, 25, 35% of their money should be in real estate. So, so if you've got a $100,000 portfolio, that's $25,000 would be just fine in real estate and REITs. Why I like REITs is obviously they give you that diversified exposure. So, while I still own real estate rentals, single rental properties, I've got lots of money tied up in each one of those. And it's just, the single family residence properties. So I want those REITs to give me diversification through commercial properties, different types of commercial property like office and warehouse and self-storage, stuff like that, but also geographically diversified too, because I've got my real estate rentals here in Medellin and then back in Des Moines. What happens when those two markets fall out for some reason or another? Then I want that other money in that broader diversification across the country, really. As far as some of the fundamentals of REITs going forward, the Fed's on hold with interest rates, so it should be pretty clear sailing for a lot of those. What else do we have as for questions? Okay. Thank you for the info. Actually, index fund I would reference converted to Admiral shares. Okay. Any thoughts on IPO? Oh. I was just about to read your question and you retracted it. Got any other questions on here? Like I said, once we get done here, check the description in the links below. Check Friday's video because it was a huge video. I think it's upwards. I'd have checked 22,000 people have watched it so far. Great investing strategy to getting those longer term returns. Okay, so it looks like questions have pretty well slowed. JMI Jumia Technology. I haven't looked at it yet. I can look at it and get back to you. And it's a good point. If if I don't get to your question, or if you have a question you don't want to ask it in the chat window, it usually takes about an hour for YouTube to process these live streams, and then they go up as a video. So just go to the video, ask your question in the comment section. I answer all the comments and I get to all the comments because that's part of the engagement. Part of what I really love about YouTube here is talking back and forth with you. Uber IPO, Spencer, great question. And I'm actually going to be doing an investing in IPOs and Uber IPO analysis here pretty soon when they start. They get ready to go public. Now, what I would say is I would generally hesitate, generally hold back on investing in an IPO when it opens. And this is actually what I did working with venture capitals for a lot of my career, is that what you don't understand is all the work that goes into bringing a company to IPO. All the early investors, the pre-IPO companies, and the venture capitalists, they want as much money as they can get, and they're squeezing this as far as possible. So that IPO price and then that initial knee-jerk reaction, it's usually pretty high. When I was working with VCs, then you price that IPO as high as you think you can get it. So there's not a lot of value left a lot of times in these IPO prices. And what you'll see is that as the IPO comes out, you'll have that knee-jerk reaction, everybody piling in. But in over the 3 to 6 months, then what you have is a lockup period for those earlier investors, the VC firms and stuff like that. That lockup period starts expiring. So what you have is a kind of an artificial weight on the stock prices, where you've got a lot of the supply from these early investors, where they can sell out of their investments. That it really weighs on the shares. So what you usually see is 3 to 6 months after an IPO, the stock price kind of struggles to go higher, and a lot of times it'll come down. So what I like to do whenever a hot IPO comes out is I'll just do an analysis on the fair value, what I think the fair value is, and then use that to determine when to invest. I was fortunate enough to invest. If you remember when Facebook came out, I think it came out to be around $42 a share on its IPO, well over what it should have been worth at the time based on fundamentals. So I held back a little bit and was able to get it at $20 a share. I think it was like 3 months after the IPO. So if you really do your analysis, and I'll be doing an Uber analysis on the channel. Then you can get some really good deals and still take part in some of these transformational companies. Thoughts on Alibaba stock? I've loved Alibaba in the past. I haven't looked at it recently, but we've talked about with the dividend portfolio. I think this is a once in a generation chance to get some of these Chinese companies. Alibaba is the Amazon of China, and they're going to be growing. I think even at that slowing economic growth, about 6% for China GDP, and it's still maybe about half the size of the U.S. economy. It's still contributing like twice the economic dollars to the global GDP every year as the United States, just because it's growing so fast and it's so huge. So I definitely look at Alibaba. I'll look at that and kind of update in the comments as far as that. What else? So we got WPC and VNQ REIT. We actually featured WPC, which is a real estate investment trust that is one of the few that has international diversification. So a lot of U.S. real estate, but also a lot of real estate from Europe. So I like that one. But my favorite's always got to come back to the VNQ, the Vanguard Real Estate Trust, because it's very well diversified across the real estate in the United States. Very good. Very, very good dividend. I'd invest in both, though, frankly. I think, I've got VNQ in my portfolio, and I've got some shares of WPC as well. What else do we have? Do you think Disney can beat Netflix as a streaming service? I think it can. I think Disney is a great opportunity. We actually just highlighted Disney stock a couple videos ago, I think. And a lot of you saw that 10% jump that it had on Friday because it came in under Netflix as far as the streaming service. And I won't say I hated Netflix. But it's just so expensive, so expensive. And if you actually look at their cash flows, Netflix is spending, and God bless them, they got some great content, and they're really leading the way in streaming. But they're spending tens of billions of dollars in this content, developing this content, and they've kind of got into that trap because you have to constantly put out better and better content. So if you look at their actual free cash flow, I mean, they're spending years and years of worth of free cash flow every year. So it's very hard to justify going into those price levels with Netflix. But I think Disney, since it is moving into that space, and it's lined up some great some great shows, and it's obviously got the content already. They've got the Avengers. They've got all those that great content that they can use for that streaming service. And yet it's not horribly priced like Netflix. So you get that traditional media company, but you also get that transformational streaming service at a lot better price. So I mean, I'd have to look at where it's actually trading on a price value basis right now. But I'd say as a long-term investment, you can definitely look at something like that. Realty Income Corporation, thinking of investing in them, already invested in Fundrise. I've liked Realty, ticker symbol O, for quite a while. I haven't looked at it in a while, so I'd have to look at it and get back to you. I think it's some of these individual stocks, even in the real estate investment trust space, are pretty lofty right now. So you really got to watch out where you're buying in now. I think Realty Income is probably one of the ones that's kind of expensive right now. But you really have to look at understand something we talked about quite a few videos ago actually, is when you're investing in REITs, watch that FFO, that funds from operation calculation. You can't use price to earnings here because of that depreciation expense that they have that throws off those earnings. So just look at the FFO, the price to FFO ratio. I think for real estate investment trust, the average is around 14 times right now. So the price is 14 times that annual funds from operations. So you can kind of use that as a marker for whether Realty Income is expensive or not. So I appreciate everybody being here on the live stream again. I think I'm going to end it here. I've got to get to the gym. It's a legs day, so obviously I would much rather spend the time here than going and doing that. But it's got to be done. Like I said, I appreciate everybody coming out. If I didn't get to your question, again, it takes about an hour to process these videos on YouTube. Then it'll go on the channel. Just go to the comments, ask your question, and I will be sure to get to it. Like I said, I love this engagement. Love talking back and forth with you, even if it's through the chat right now. So yeah, Greg just updated us on Realty Income, price to adjusted funds from operations, which is a little bit different, but still that funds from operation that's over 22, which is pretty expensive. Again, thank you. I appreciate everybody being here. I will see you next week, 1 p.m. 1 p.m. Eastern, 10 a.m. 10 a.m. Pacific. If you've got any questions, I always love hearing your questions and what kind of content, what kind of videos you want to see most. Check out Friday's video if you're interested in that long-term investing strategy, that 20, 30-year investing strategy. So thank you for being here, and I will see you next week.